All right, good morning, everybody. Sorry I am a couple minutes late today. My bench press and deadlift session lasted a little bit longer than usual. So, let's start this off with the classic press 1 in the chat if you can hear me. Also, leave a like on the video. You can see that the mustache is growing in quite nicely. One. All right. Thank you, Tims. Thank you for being here with me this morning. Let me close out of all these tabs before I overwork my computer. Keep OBS open, obviously. Don't need Chrome for right now. So let's go over to the charts. We're having a decent gap down this morning. SPY is trading at 379.2. And this is from the close at around $380. So pretty small gap down. I still do have the Iron Butterfly open. So if we go over to the Robinhood account, good morning, UT. If we head on over to Robinhood, looks like we're making $90 so far this morning, thanks to that SPY Iron Butterfly making us a little bit of money. So what I did was I sold the 382, I bought the 380 or 378 put, and then I bought the 386. So my assumption today is that SPY is going to be at $382 towards the end of the day. Now, with an Iron Butterfly, you want to close it as close to the strike price. So right now, SPY is trading at $379, so it's about $3 away. But I want to close this Iron Butterfly as close to $382 and as close to the expiration date as possible, right? That is going to bring down the extrinsic value of the 300. Actually, sorry, that's going to bring down the intrinsic value, I should say. It's going to increase the extrinsic value, but since this option expires today, it's going to have hardly any extrinsic value. But that's going to decrease the intrinsic value, or the difference between the strike price and the current value of the stock, to zero if it hits 382. So that would decrease both the call option and the put option's intrinsic value if it's trading immediately at 382. And then the closer that we get to expiration at 4 o'clock, the less extrinsic value that the option is going to have. So the less time that the option has to expire, and the less volatility that these options can experience. SPY put spreads are printing crazy for me today. Good job, SPY to Mark. Proud of you. So let's look for some opportunities today. I was trying to get into Nike yesterday, but we never got the price target that I had wanted, and today it's down another 0.75. So this looks like an opportunity that I might just have to miss out on. Sometimes it's okay to miss opportunities, but my assumption was that Nike's going to have a pretty bad earnings report, which is coming out today after hours, and my guess is that it's going to probably try to fill at least this gap right here, which will put it under $100 and some odd cents, like a few cents. So we could do a put debit spread on the assumption that it's going to be under 100, but given that it's sold off so much within the last, looks like 6 trading days, we're going to be paying a pretty premium in order to open that. I am going to look at it just to see, just to see if it is decently priced, but my assumption right now is that it's not. Sorry. Let's see though. That Iron Butterfly is making us a little bit of money right now. But assuming NKE is going to be under, why is Robinhood like this? You'd think that a brokerage that focuses so much on design would have a responsive UI, but for some reason it's not very responsive at all whenever you decrease the width of the browser to a certain degree. Wait a minute, what? Okay, so somehow the bid ask on this is 660. Am I doing a... I'm so confused. How is that possible? Okay, so they're going for about 50 cents a piece to assume that Nike's going to be below $100. So you get a 1-to-1 risk-reward ratio. For this kind of trade, I would probably be looking for like a 1.5 to 1 or a 2-to-1 risk-reward ratio. So for this trade, I don't feel like it's worth it. That's not to say that you can't take the trade anyway if it doesn't have the risk-reward ratio that you're looking for. You can just put up less risk accordingly. So for this trade, instead of, putting on more risk for a 2-to-1, I'd probably put on, I don't know, like, for that kind of trade, I would probably put on like $400 to $600 of risk. But given that it's a 1-to-1 risk-reward ratio, I would probably only put down like $200 to $400 of risk. You could also buy just a long put option if you only have level 2 options trading. The problem is that the puts are so damn expensive that you're likely to overpay for it. So I'm looking currently at the 103. I'll actually pull it up on this chart so y'all can see what I'm looking at. I don't think I'll open this trade, but I will show y'all the chain and what I'm observing, I guess. So currently Nike is trading at 102.30, right? And I'm assuming that it's going to be under $100. So we want to find an option that has a break even of around 100. So if we choose this 102 strike price, we subtract the 415 that we're paying in credit. The break even on this is 102 minus 415, $97.85. But my assumption is that it's going to be under 100. So if this option, if I buy this option and Nike isn't below 97.85 by the end of this week, whenever this option expires, then I'm not going to make any profit. So that's the way that I do level 2 options trading. I look at the break even. That is the most important thing for me. So if we choose a higher strike price, if we go with an in the money put, even the 104 we're paying 535. So we subtract 104 minus 535, and our break even is 98.65, which is closer to the $100 mark that I want. But now I'm having to put up $500 in risk, and I told y'all that I'm only okay with putting down like $200 to $300. So the next option would be to do a put debit spread, where I would just assume that it would be under 100. I would sell the 100 put. I would buy the one above that at 101. But this option is going for 55 cents. So this means that I can only make $45 for every $55 that I pay, which is actually worse than a 1-to-1 risk-reward ratio. So for me, this trade isn't worth it right now. I just don't think that I would be willing to take on that risk given how much it's already fallen over the last 6 trading days. I do think that they're going to have a bad earnings report similar to Lulu, but they have already dropped from 116 to 102, which is a 14-point drop on 116. Well, I can't type today. 116, that's a 12% drop that it's already experienced. So the likelihood of going down another 2% is starting to decrease the further and further that it goes down. That's the way that I kind of think of it. But SPY is still trading at 379. We might be able to get an opportunity out of SPY trading flat today. We have the Iron Butterfly open already. That's up about $6 at the moment. Actually down $4 now. since it's dropping below that 379 mark. So let's do a quick little analysis. Somebody in the Discord actually posted something that was very useful. Let's see. I'll link the Discord, create an invite, and y'all can join. Whenever I'm not in these live streams, I'm usually over in the Discord chatting away. So if y'all ever want to hit me up, or if you want to chat with, about 4,000 other traders, then this is the place for you. Anyway, going over to the premium chat. So this person actually used ChatGPT, not GBT, to come up with their analysis, which I thought was actually pretty freaking brilliant. A few potential reasons why stocks might go down in response to the Bank of Japan's decision to raise the upper limits for their target rate. So that means that bond yields overall are going to start going up because there's more uncertainty, because Bank of Japan and Japan has kind of been like the safe haven almost of the world. Like if you look at the Japanese yen, it really doesn't fluctuate a ton, other than, over the course of the last year when the dollar has just been wrecking everything. Like if you look at, let's see, Japanese yen to USD, it has a lot of stability, right? So back in like 1980, it started to go up after basically the collapse of the Japanese stock market, and it really hasn't fluctuated by much ever since about the 1990s, right? So again, the yen is kind of seen as a safe haven, and now with the Bank of Japan raising their rates, that means that there is more risk coming to the yen, coming to this safe haven, right? So that's why you're seeing a little bit more fear in the market today, and why the stock market is falling a little bit. I read on Yahoo Finance this morning, hawkish as hell. Yeah. Yeah, I mean, if Japan needs to raise their rates, there is some real problems going on, because again, this has been the safe haven. And if their economy is collapsing, their economy is freaking huge too. That's the thing. It's a very small country, but they produce a lot. Let's see. Economy size by country. So it's United States, China, and then Japan. Like, this is a very small island, but they are the third largest GDP in the world. So if Japan starts, having some issues, that causes world issues. Yeah, world economy is definitely taking a major dump. And you can thank this one right here, China, and also, where's Russia? Russia. They're trying to strong arm the, I guess, West. West also includes, Taiwan. I would say Japan, but I'm not too informed about the way that Japan's government works, so can't really talk about that too much. But then, the rest of the Western world, Europe, the United States, obviously. Like, we have three countries, basically: Russia, China, and the UAE, the United Arab Emirates. I don't remember the acronym. But you have these three countries that are basically trying to attack the Western world with higher energy prices and trying to choke our supply chains, is what China's doing, basically. So it's kind of a war. It's a war of economics. The East versus the West, and it's basically a war for capitalism. Is the way that Jason, I forget his last name, but he's a angel investor. The way that he put it, though, is that this is a war for capitalism, and if China wins, that is basically the detriment of the world, because China, the way that they see things is they're very brutal whenever it comes to their work ethic. They pay people like $2 an hour to do very hard, arduous work. Whereas in the United States, we're trying to get rid of that with technology and try to free up people's time so they don't have to work for $2 an hour and they can work on more entrepreneurial things so people can start their own business. So that's kind of the beauty. I know that we always talk shit about, America and the economy, and how the government is very hyper-capitalist, but the beauty of America is the financial freedom that you get compared to that of China, where people are forced to work for $2 an hour, and it's very hard to work up over in China versus the United States. But enough of my tangent of the East versus the West and the war on capitalism. SPY is currently trading at 378, so yeah, your put spreads are probably doing pretty well, Spider Mark. I do think that we could maybe crack 378 today. Sorry. Let's see what else is going on in the world. Senior State Department says the U.S. is seeing significant shortage of ammunition in part of Russia, and that is increasingly a problem for Moscow. Interesting. U.S. Postal Service announces significant increase in electric vehicle purchases. Interesting. Postal Service will electrify trucks by 2026, and a climate win for Biden. It's a good move, given what happened 2 years ago with Workhorse and that contract falling through. I don't think that Oshkosh and Ford are going to be the ones to make the electric vehicles, because they're going to make it for probably a lot more, and they're going to be more expensive than what Workhorse probably could have gave them, but it is what it is. Government agencies usually don't make the best choices. Twitter rolls out Blue for Business. Don't really care for Twitter news. USA building permits. So let's look at the economic calendar. I haven't checked on that this morning. I don't think that there was anything big. Again, yesterday and today are, well, I guess yesterday was pretty down. But yesterday and today were likely to be flat because there wasn't any economic data coming out. But now that you have the Bank of Japan raising rates and causing fear throughout the global economy, we could see a decent down day. So let's see. Wow, that was a pretty awful settle-off at around 10 p.m. of all times in the after hours. Maybe there's a decent chance we continue to come down, but I'm more on the fence. So I'm still kind of, I guess, hanging on to the idea of my iron butterfly that I had open. Now, I think that going back all the way to 382 is a bit of a stretch at this point. That's another couple of important price levels up. Not only the 380.8, but you're going to have to get past this candle of significance right here. Between 397.7 is the open of it, 397.7, and a close at 378.44. You divide that by 2 and you get $388. So, sorry, that's not the right price. I done messed up. 379.7 plus 378.44. 378.44. Divided by 2, you get 379.07. Sorry about that. I think there's a decent chance that we go back above that level at 379. So I think I'm actually going to take the inverse of what probably everybody else is doing this morning and betting on the stock market continuing to come down. I think it's already fell a decent amount based on the news of Japan raising rates. I do still think that there's a decent chance that we continue going down. But I think in the short term, we're probably going to head back to 379, and that should give us a decent opportunity. So I'm going to open a 379 call debit spread, assuming that we're going to reach that sometime by the end of the day, and I'm probably going to close as soon as we hit that 379 mark. Just for a quick little kind of scalp, I guess. Let's see. It's trading at 374.37 at the moment. Gonna set the expiration date for today. And again, I'm assuming we're gonna go back to 379. Right now, these contracts are kind of expensive. But there is a decent amount of upside to them. Let's see. Yeah. I mean, there's about 10% arbitrage. So if SPY ends up going to 379 and I open these spreads, they should be going for around 60 cents each. What are the prices for my Iron Butterfly? They are 379, 382, and 385 or 386, I think. 0.53. Okay. So there's about 10% arbitrage in this trade. I do want to set up some stop losses, so maybe we close if it goes down all the way down to 378. At that point, these contracts should be going for about 40 cents each, roughly. So given that our risk is about 13 per trade, I'd be willing to risk maybe 400 for this trade. I'll open about 25 of these. It's already going up a lot. Getting less arbitrage out of it, but hopefully we can get in. Doesn't look like it. Got any goals for 2023? Got some pretty big goals that we'll talk about, I guess. Let me make this trade and I'll talk about my goals for 2023. Do you always open your trades 30 minutes after open? I generally try to stay away from opening them like the first 5 to 10 minutes, just because whenever you're trading spreads, the bid-ask spread is going to be that much worse. Looks like I didn't get filled for that trade, so I think we're going to miss that opportunity. Let's see. We could take the opposite trade, wait for it to hit that 379 mark, and then do a call credit spread and short it down to 378 maybe. So that would be kind of hedging against the Iron Butterfly that I have open now. So I'd be taking looks like we just hit 379, so let's try to do now a call credit spread. Yeah, this is going for decent credit now. Looks like we're busting up after that 379.02 mark. Jesus Christ. We end up going all the way up to 379, high 379s. We might just have an engulfing candle, which will be very bullish in terms of technical analysis. I'm not a huge TA fan myself, but these options are only going for 50 cents credit. Let's see. That doesn't make much sense. Oh, I'm choosing the wrong strike prices. Okay, so the options that I was looking for earlier, the call debit spreads, I was opening 378, 379. They were going for 55 cents a piece. Now they're going for 66. So now I'm going to take the opposite trade. Oh, shit. Technical analysis is telling me no. Let's see what we can get for this. So let's try to open this at the bid price since we're selling it. It's a credit spread. Maybe we can get a little bit extra credit out of this. We'll see. This trade I'd probably only be willing to risk like 300. So let's say that it goes all the way up to 3 80 at the very top of the range from this morning. These trades should be going for around 80 cents a piece. Right now they're going for 68, so $12 risk ish over, sorry, 300 risk over 12 risk per trade is 25 of these spreads. So the same as earlier, just flipping the trade. Oh, Jesus. Oh, the bid just dropped on me again. Filling these damn orders is so hard sometimes. All right. So I opened that call credit spread, so I'll post that over in the trade alerts for the premium Discord. But basically my assumption is we're going to revisit that 378 mark sometime later today. That's my guess. But I'll probably close if we go back above 380 and above. But for right now, it doesn't look like we're headed that way. We'll see. New options, alerts, premium 101, premium. Just opened a new call credit spread expiring today. It's the day trade, 1220. And I got them at 65, I think, 1675 over 25. Yeah, around 65 each. Okay. Strike prices. Well, looks like we might get stopped out of that trade already. Hopefully not. Alright, I said that I would stop out when it hits 80 cents a piece. Looks like the iron butterflies that I had opened are kind of out, at least negating some of the losses that I'm taking. But here's a trade that I had opened, 378, 379 call credit spread. Assuming that SPY is going to come back down to that what was it? Sorry. 378 mark. We don't even need it to hit 378. All we need is for it to hit 379, and these trades or these options would be going for around 60. I opened them for 65, so that would be about a 9% profit. But if it does hit my 378 price target, I opened them for 65. They'd be going for 40, so that's 25 over 65 potential profit, if correct, obviously, not always right, of about 38%. But it looks like we're still headed up. We're about to cross the highs from this morning, and it looks like we have a decent break so far. So you need a significant break, or you need to hold above the level. So this is the mark to look for from this morning's range. Above 380.4 is what it's looking like. Currently, we're trading just at that price level. So if we go up to, say, 380.6, 380.8, I would call that a significant enough break in order to exit these trades. Right now, I'm down 250 for them. They're going for 76 cents a piece. And thanks to Robinhood's non-responsive UI, it loves to cut off the ask price, which is what I need in order to close the spreads. But they're going for 75 now. SPY seems to be breaking the 380.4 mark, but no confirmation just yet. We hit 380.64, but we sold off immediately from that. So let's see how this plays out. I did want to get to Jan's question. What are my goals for 2023? So I have goals to start racking up the amount of money that I'm using for options trading. I would like to be able to trade with confidence with using $25,000. Currently, I'm only using $10,000 total to trade options. So given, my track record of making around 4 or 5% a month, I would go for making 10,000 times, we'll call it 5% a month. $500 a month to something along the lines, given that I'm using the same strategies, $1,250 a month. So that's really my goal, to be able to increase my risk tolerance. Obviously, that's going to require more cash for me to have. So second goal is going to be to build up the cash pile by increasing my income. So my income right now is roughly, from all my income streams, is roughly $4,500 a month is what I calculated it to be yesterday. So that's from the YouTube, Patreon. That's from trading itself. Those are my 3 income streams right now. But I'm looking to add some more income streams. I'm looking to create, hopefully, a very useful trading tool for people. So it's going to be a trading journal, and all the trading journals that I've seen on the market so far are charging like $50 a month, which I think is a bit outrageous. I would love to know y'all's thoughts on what you think is a more reasonable price for a trading journal where it's going to automatically log all of your trades for you. So this is something that I've kind of always struggled with, is inputting my trades, just because, it's, boring, repetitive tasks. Like, I want to try to automate that the best that I can. So y'all tell me how much money you would be willing to pay per month to have that automated to you. And that's going to give you back data, important feedback for your trading. So basically, I'm looking to turn my spreadsheet that I have into an actual app. Yeah, I know. I feel like we're in 2022 and we still have to manually input our trades. And that's another issue that I've seen with most of the trading journals. They'll claim that they're automatic, but if you actually try them out, most of the brokers either aren't supported, or like you still have to enter them manually by importing a CSV or comma separated value file, right? Like, it makes no sense. We're in 2022 and we still have to manually input our trades. It blows my freaking mind. You should look into some side hustles on gig apps for a little bit. So I have some app developers in mind already. Right now they're quoting me for about $15,000. The average has been like $10,000. There's one developer that I'm really looking forward to because he's actually in the space. He actually trades options. So I think that he would be a very good partner for like long term. Looks like we just had something going off on. All right, so SPY just hit 381. So those spread options are probably going to be a loss for us. Currently trading at 82 at the ask price, so we're going to have to take our L. Hopefully we can get a decently small L instead of a massively large L, thanks to Robinhood's bid asks, but that doesn't seem like the likely case for us. All right. I opened 25 of them. I'm just going to close all 25 for a loss. I guess I'll close for 82. Meh. That sucks. But that means that our Iron Butterfly is going to be working out for us, which will pay us more. So, oh well. Let's see. So, closing, options, alerts, premium, 101, freemium. Just cut losses on the 378, 379, SPY, CCS, call credit spread expiring today, 12.20, and now they're going for 79. I always get the worst fills, but that's okay. Add 2025 over 25, close them at 81 each. So I originally opened those at 65 a piece. So 81 minus 65 is 16. 16 times 25 is $400 loss. Yeah. I thought I had limited myself to 300, but I guess not. That's okay. So $400 loss for this trade. Looks like SPY is coming back down. Well, the spreads are coming back down, but SPY itself hasn't come down that much more. But we hit that 380.4 mark. Let's see if there's any sort of news that might be helping out the market right now. So yeah, that dragged my portfolio down. I was up good 121, but now down 80. But the SPY Iron Butterfly is making up for it a little bit. Currently trading at 220. I originally opened this for 277 a credit, and I opened 2 of these. So this might be the trade that actually ends up working out by the end of the day, hopefully. With us trading above 380.4, as long as we catch a bid or stay above that price, I think that solidifies that we're going to have either a flat day or a positive day. But for right now, sort of undecided just because it's still hanging at that 380.4 mark. How long do I plan to hold the Iron Butterfly? I'm planning to hold the Iron Butterfly until SPY hits $382. So that is the goal for an Iron Butterfly. You should want to close it at the latest time possible whenever the stock is trading at the strike price that you sold. So whenever SPY hits 382, that's going to be my alert in order to close this trade. Now, I could continue to hold it later into the day if I think that SPY isn't going to continue the rally. So let's say that SPY hits 382, but then ends up stalling out for the rest of the day. In that case, if we start trading sideways, I would want to hold that option because it's going to lose more and more of its time value as the end of the day comes along. Really considering subscribing to the Discord? I would say that, I have around 100 members, so they can probably vouch for me if they don't like it, they can vouch against me. I would probably try out the free trial. So we have a free trial for the Discord. It lasts 1 week. Let's see. We also do have a free Discord. Let me actually pin the free Discord, and I will also send the link to join the premium. So the premium, there's a 1 week free trial for it. If you decide that you don't want to join, you can just cancel at the end of the week. But let me find the link for the subscription. Tiers, payments, preview. That's what we need. So there we go. And that also, it's not just the trade alerts that you'll get. You'll also get Q&As. I do Q&As every Sunday for the premium Discord. Also, like if you have any questions during the week, I'm usually pretty available to where I'll get back to your question in about an hour. Depending on how busy I am. Sometimes I'm more busy than others. But a lot of other benefits. You get the nice little options tracking spreadsheet. Probably to be replaced by an app soon. Not really sure how I'm going to structure that. But anyway, SPY's coming back to 380, so it looks like SPY to Mark had it right. The trade turned around on us. And it looks like we got rejected by the 380.4 mark for right now. So we went significantly above it, so that's kind of surprising that we sold off from it. But very hard to predict this market given all the volatility that we're experiencing. The 10-year Treasury yield is up again today. Another gap up from 358 to 366. That is pretty freaking nutty for the bond market to be going up that quickly. But, rates have to rise in order to kill inflation. That's the problem. Is that the Fed doesn't have any other tools to increase production. Like production is based on, the the businesses in the world. We rely a lot on businesses in other countries in the world to do our production. And, we're having, this global kind of recession, which is going to decrease the supply chains overall. But demand needs to be destroyed too, right? So prices are just based on supply and demand. Whenever the demand for everything goes up and the supply stays the same, then prices are going to go up because there's more money buying the same amount of goods. And whenever the supply chain gets worse, which is what we're experiencing right now with China, Russia, and those few countries trying to stronghold us or strong arm us, they're decreasing our supply chain. So that's just kind of adding to the inflation that we're experiencing, because the lower that the supply goes, there's less goods now and the same amount of money to buy less goods. So the prices of the goods are going to go up. So we have both forces. We have increased demand because of all the money printing that's gone on over the last 2 years. And then we also get lower supply because of other countries, chokeholding us, and, businesses starting to slow down because the economy is getting worse with the higher interest rates. Will the stock market go back up by next year? I'm running a poll today, I think, asking people what people think the stock market is going to do. My assumption, though, for this year is that SPY could be revisiting the $320 level, which came from pre-COVID. So that would be way down here on the weekly chart. Currently, we're trading at $380. Actually, I'm sorry. It's not 320. It's actually 340. So I think that we're going to fall probably another 40 points for SPY. It's currently trading at 380. So that would be down another about 10%. Now, the timing of that, I'm not so sure about. But I think what the Fed wants to do is erase the mistake that they made with COVID, right? So during COVID, we thought that it was the end of the world, and we thought that we needed to print all of this money in order to save all of these businesses. And some businesses, sure, I would say probably needed it, like the cruise line industry probably needed the money. But there's a lot of businesses that got money that they didn't need. Like you saw Stanford, of all companies, or not even a company, it's a freaking school, getting a PPP loan. So there was just all of this free money that was flooded into the market for really no good reason, for what was unnecessary. So I think what the Fed wants to do is bring us back to reality, which would be pre-COVID levels at $340. That's my analysis. So I think we're probably going to fall another about 10% sometime between right now and the end of next year. I think we're going to revisit that $340 price level. I don't think that stimulus checks were the real problem. I mean, if you really think about it, we got, 3 stimulus checks for $3,600 or so, right? I think it was a total of like $3,600 or $4,000. But if you look at all the money that went to businesses in that same time frame, that completely outweighs all the money that the American people got. And that's the problem with the United States, is that these government leaders pander to corporate America, is that they give all of this money to businesses that don't actually need it, companies that are already profitable. I don't want to get too political with this, but look at the money that has gone to tech companies, vaccine companies, things of that nature over the last 2 years. Look how much money has been funneled into Pfizer And like, yeah, I do think that the vaccine was effective in the beginning, but now that it's mutated, 5 times, it's not as effective as it used to be. And these companies aren't putting in the research to develop vaccines for the newest variant. At least that's what I've seen. Like the efficacy in the beginning was like 95%, or it was stated to be around 95%, but now the efficacy is just as good as the flu shot, which is about 50 to 60%. So, I mean, I think that there's a lot of money that the government is giving to businesses that is just unnecessary. All right, we're trading at 381. These spreads are going for, or I guess these iron butterflies, I should say, are going for 220. We're almost at the 381 level. I've got two of these spreads. I opened them at 277. So right now we're up by $120. Harvard gave back their PPP, I think. They shouldn't have got it in the first place, though. Even if they gave it back, there was money that was spent in, transferring the money over. Like, you have to hire somebody in order to, facilitate that transfer and then have that money come back. Like, even if they did give it away, like, there's so much unnecessary government spending going into corporate America. And Harvard is just one example. Like, there's plenty of other companies that didn't need it that still got the PPP loans. Looks like the Bank of America leaps put and the gold leaps is actually up today. That's a bit shocking that gold is on the rise today, up 1.7%, given that the rates are going up. You would think that the dollar would go up, which would send gold down. But if we look at UUP, it's actually down today. Interesting enough. So I guess this is really recession fears continuing throughout the market, global recession fears now, which means that prices overall are going to come down, which ends up sending the dollar just because there's not as much need for it, I guess. But the dollar UUP is down 0.8% today. It is basically collapsing ever since October. Very interesting. I want to look back on a longer time frame, see what happened back in 2008. So back in 2008, the great financial crisis, the dollar ended up falling from 25 to 22 based on the UUP, so about seemingly about 10%. But this drop has been absolutely brutal. We've gone from 30.1 to 27.8, so $2 on 31, almost $3. We'll call it 2.5 over 31. We've gone down by 8% in one quarter, versus 2008 took us 3 quarters to experience that 10% drop. I guess we did peak in 2008, back in 2007, I guess, at 29, and then came all the way down to 22. So that was a 7-point drop in 29. So that was a total of a 24% decline for the dollar. But generally during these recessions, the value of the dollar just ends up getting wrecked. 2018 was the same case where they raised the interest rates. Wait, where is 2018? I think it was 2017, actually. I thought it was the end of 2018 was the last short recession. Let's see. Fed funds rate. So the last time that the Fed decreased the interest rates is what I'm looking for. starting in 2019, actually. So let's see. Obviously, March of 2020, the dollar went down. But at the end of 2019, which is when they started to cut the rates, actually in August of 2019, so that would be Q2, August 2019. It was trading for around $27 for UUP, and obviously with the COVID, that did kind of exacerbate things, and it went all the way down to 27. So that's a 4-point drop on 27. The dollar went down about 14%, but this just seems brutal. Like, this is worse than COVID for the dollar. It's crazy. How did I start trading and when? I started trading back in 2016. So I used to watch Ricky Gutierrez. I was a huge fan of his trading style back then. I was really into day trading because, you know, who isn't into day trading when they're 20-something years old? Like, it seems like a fun, easy job, but then the reality was, like, I was absolute dog shit at trading in the beginning, and, like, that's something that you're going to have to deal with. If you're brand new to trading, you are going to be crap at it. Trading is a skill that you have to develop just like any other skill in life. Like, if you want to be a programmer, you need to learn different languages to program in, and you need to, you know, figure out how to program databases. You know, I have a very short history of CS myself, so I don't know a lot about it. I did study it in college, but I started trading in 2016. I was also going to college to get my CS degree, computer science degree. And at some point, I just found out that, like, the school system just wasn't for me, because the school system doesn't teach us applied uses, right? Like, they'll teach us all about the theory, and they won't teach us how to actually use it in practice. So during my time in CS, I was actually starting to develop websites. That way, you know, I could get some actual practice. I ended up doing like an internship, and that's the best thing that I think you can do if you're getting a college degree, is to actually get an internship and actually start working and applying the skills that you're learning from your college education. But I ended up dropping out of college in 2020 to pursue trading full time. Wasn't very successful in the beginning. You know, in March 2020, I think I had maybe a 50% win rate. But, you know, I've developed and refined my skills over the last, 2 years, trading every single day, like 3 to 5 times a day, to where now my win rate is 70% versus what it used to be at 50%. So, you know, it's a skill that you have to develop, and a skill that you have to practice, and a skill that you have to put time into actually learning. Like, if you're learning from all the different YouTube videos that you see, but then you're not actually applying what you're learning, then you're not going to get anything out of the experience. That's something that is very important, is actually putting in the time to trade and getting the real experience instead of just all of the theory. And how much money did I lose before I started trading, making profit? That's a good question. I didn't start out with a lot of money, so that helped me. Had I started out with like $10,000, I probably would have lost half of it. I probably would have lost like $5,000, but given that I only started trading with like $3,000, that meant that my losses were only like, a couple thousand, right? So now, over the last year, I've made about $8,000 in profits trading options. So my net profit since, I guess, the beginning of my trading career, full time, has been a total of $8,000, which obviously isn't a lot to write home about and, brag, considering that it's 8,000 over 48 or sorry, 24 months, it's like $300 a month. Like, it's pocket change, right? But as I continue to grow the account, as I start to develop more risk tolerance and build my cash pile, then I have more money to work with. So I started with 3,000. So if I had made the same amount of profit that I am today, about 5% a month, I would only be making about 150. But now that I'm using 10,000 a month, I'm making 500. And once I start to use, say, 25,000 to trade with, then I'm going to be making 1,250, and so on. Now, I don't know where my risk tolerance is going to stop. Maybe somewhere like $50,000, then I'd be making like $2,500 a month. But it obviously depends on like my financial circumstances. Like, if I'm a millionaire, then I can afford to lose, I don't know, $50,000. Like, that's a lot easier than, losing $50,000 when I'm only worth $60,000. So it's all relative, right? What's my go-to strategy? Spread options. Buy and large spread options. Iron condors, iron butterflies, credit spreads, debit spreads. Those are my favorite strategies to go to. That's what, I've made a lot of my money doing, so that's what I continue to do. SPY is currently trading at 381.35. These spread options are going for, I guess the iron butterfly, I should say, are going for 205. So we've made about $150 of profit so far. I'm still waiting on SPY to hit that $385 mark. Or, sorry, $382 mark. And we're only 50 cents away, so it seems pretty likely that we're going to hit it. It is 10:30. All right, I'll make a deal with y'all. I will stay on for an extra 30 minutes to close this option if y'all will like the video. Right now we have 44 viewers and only 10 likes. So if we can get the likes up to 25, I'll stay for an extra 30 minutes until 11 o'clock. I'll zoom in so y'all can see the like count. Whoops. Currently at 12. Let's get it to 25. And I'll stay for an extra 30 for y'all. 18 likes. Y'all like that real quick. $22. All right, there's 25. Thank y'all. We shall continue. And if you want to like it after we hit 25, I'd appreciate it, but you don't have to. Anyway, going back to Thinkorswim, SPY's currently trading at 381.70, so we're just about at that 382 mark, which means that we can start to think about closing this SPY iron butterfly. Now it's gonna, we have to see if we're gonna trade flat after we hit that 382 mark, or if we're just gonna keep busting up. But right now the ask price for this is 203. Really wish that Robinhood had a responsive user interface, but does not. But I have two of these that I opened for 277, and it looks like I might be able to close them for 204-ish at the moment. So, oh, my nose. Long on likes. Calls on like option, or calls on likes. Alright. Dang it. What the heck? I don't want that. I guess with the stock market going up today, that should help Nike to do a little bit better, hopefully by the end of today, and we might be able to open that put debit spread. Potentially. Alright, I'm going to try to close these at 204. See if we can get that price or nah. I meant to close both of them. Oh, sorry, that startled me. God damn it, why is the ask going up? The ask should be going down. How is it 205 still? Ugh. Alright, I guess we'll have to close them at 205 and give up $2. Gotta love Robinhood. All right, we actually got a better fill. We got filled at 204. So that's a closing options alert. I'll post that in the Discord. Made a nice little $140 of profit or so. Let's see. We're currently trading at 382. Might have should have held one open, but that's okay. Kind of wish I had opened more, but it is what it is. Post that in the trade alerts. Nope. Come on now. There we go. Meh. All right. Come on now. Closing options alert. Premium 101. Premium. Just took profits on the 382 IB Iron Butterfly expiring today. 12. Today's the 20th at 204 each. Let me type in this other strike prices: 378, 382, and 386. All right. SPY Iron Butterfly. That is not the right one. So I'll just type in the strike prices. That might find it for me. 382, 382, whoops, 386. All right, there we are. That's the one that we need. Close out of this search. What the heck? Did I only take a screenshot of the top of it? Opened at 277 each. So profits were 277 minus 204, 73 times 2, 146 profit. 146 profit. All right, sweet. Do you always buy both a call and a put for each options trade? So that was an Iron Butterfly, so that would be a combination of calls and puts. But my strategy is always, and what type of options I buy is going to depend on what sentiment that I have for the stock. So there's three sentiments that you can have for the stock market. You can have bullish, to where you think the stock is going to go up. You can have bearish, to where you think the stock is going to go down. And then you have neutral, where you think the stock is going to trade flat, right? There's only three directions that a stock can go. So for bullish, you would either buy just a regular call option if you have level 2 options trading, or if you have level 3 options trading, you could do a call debit spread. So with a call debit spread, if I think that SPY is going to be above, say, $384 today, I would buy a $383 call, and I would sell a $384 call. Now, this isn't a trade that I'm actually looking to make because I'm undecided if we're going to be bullish or not until we go significantly above 382. But that's how you would set up a bullish trade. That would be a call debit spread. If I was bearish on the stock market and I think it could come back down to under $380, I would use a put debit spread. So put debit spread is a bearish strategy where you would buy the $381 put and then you would sell the $380 put, right? So that's bearish. We have bullish, we have bearish. Now, if I think the stock market is going to be neutral, there's two strategies I could use. I could either use an iron condor, where I set two strike prices that I think the stock could be between. So likely SPY is probably going to trade anywhere between $385 and $379 by the end of the day. So what I would do to set that trade up is I would start out by selling the 379 put. I would buy a 378 put. And then I would sell a $385 call, since I'm assuming SPY is going to stay below 385, and then I would buy a $386 call. So that's how I would set up a neutral strategy, right? So that's an iron condor, and then you can also use an iron butterfly. So an iron butterfly is when you choose one strike price that you think the stock is going to be at the end of the day. So let's say that I think a SPY is going to end the day at $383. Right now it's trading at 382, so it's pretty close to it. I would start out by selling a 383 put. I would start out by selling a 383 call too. So selling a 383 call, a 383 put, and then I would buy two separate strike prices. So the put option you want to buy with a lower strike price to where you think the stock is going to be above. So I'd probably buy maybe a 379 put, and then you want to buy a call option with a higher strike price. So if I think that SPY is going to stay below 385, then I would buy a 385 call, right? So my assumption is that SPY is going to end the day at 383, but I'm also assuming that it's going to be between 385 and 379. And the closer it is to $383 and the closer towards the end of the day that we are, the more profitable that iron butterfly is going to be. So that's all the strategies for bullish, bearish, neutral. You could also do credit spreads if you're neutral. So if you think the stock market is either going to trade flat or go up, you would use a put credit spread. So if I thought SPY is going to stay above 380 today, I would sell a 380 put. I would buy a 379 put, and then you could use a call credit spread if you're bearish to neutral. So if you think the stock is either going to trade flat or come down. So if I think that SPY is going to stay below 385 today, I would sell a 385 call and then buy a 386 call. So that's all the strategies, basically all the strategies that I use. You can also just do regular call options or regular put options if you're bullish or bearish. But generally during times of higher volatility, like we're experiencing right now, you might overpay in order to open that option. So that's why I like spread options a little bit more. You don't have to worry about the headache of implied volatility as much, just because the Vega value is kind of canceled out since you're buying one option and selling a separate option. I've seen that in ER News, earnings report news, I think, some people use straddles and strangles. Do I use them? You could use, I would say that it depends on the stock. So an earnings report is a binary event, right? It's either going to go up or it's going to go down, mostly. And then sometimes it's going to trade flat. Very rarely, but it does happen. But most of the time, whenever you are going into an earnings report, you're going to get high implied volatility. So let's take Nike, for example. This one has an earnings report, I think, today after hours, if I remember correctly. So I'm going to look at the one-year chart, and a nice little study that I like to use is called implied volatility percentile. So this is how I determine my strategies whenever I'm trading in earnings report. And right now, the IV percentile is 84. So that means compared to the last year, the implied volatility percentile is at 82. So that means, 84. So that means that it's relatively high. That is in the last two standard deviations on the upside if you're looking at a bell curve. So let me actually pull up a bell curve, I guess. Bell curve. Yeah, I would say that straddles and strangles are capital intensive, especially because of the heightened implied volatility. You're going to be paying more for that option. But let me pull up the bell curve. So basically, implied volatility for NKE Nike ahead of the earnings report is in this range right here, from 13.6 on, right? So in the light blue to the right. So that means that it's relatively high. So the chances that the stock is actually going to move as much as the markets expect is probably pretty low. It would probably be on this side of the bell curve. Now it doesn't have to be, but the expected move for NKE for this week is $8.38 when this is a $103 stock. So that means that the markets expect this to move by about 8%. 102.8. Yeah, so about 8.1% is what the markets expect for this week for NKE. So that means that a lot of people are buying options in anticipation of the earnings report. And whenever everybody else is buying options ahead of an earnings report, that means that you're going to be paying more because prices are just supply and demand. And whenever there's the same supply, so if there's the same amount of sellers going into this earnings report and there's more buyers because people expect the stock to make a big move in one direction or the other, the prices of your options are going to go up, right? So right now, implied volatility is high, which means that the demand for the options is high, which means that you're likely to overpay for an option ahead of an earnings report. So straddles, at least long straddles, generally aren't a good strategy for earnings reports, but it really depends, again, on that IVP or the implied volatility percentile. So if this IVP was something like 60%, then I would say, okay, there's a decent chance that it moves more than the expected move. But since IVP is in the, last two standard deviations, it's high, so it's less likely to experience that big move that the markets expect. Yes, Ivy crush. It's kind of what I'm trying to explain just in statistics language. The open interest on SPY puts expiring January 27th seems pretty weird. I don't really follow options flow too much. It's never been my strategy, but I know a lot of people pay attention to that kind of stuff. But it looks like Nike is actually recovering all that it lost this morning, so we might get a decent opportunity to short Nike ahead of the earnings report. It's currently trading at 103. We'll see if it heads to 103.6, and then we might take the put debit spread, assuming that it's going to go to 100. Now, usually for earnings reports, I'm not a big spender. So for this trade, I might spend like $300, $400. But my analysis basically is that Lulu had a very bad earnings report. Nike didn't sell off with Lulu like it should have. So I think that Nike has some more room to sell off. But given that it's already fallen, what was it, like 8% or 12% or something like that over the last 6 days, it is less likely that it is going to continue to come down. But I still want to make the trade anyways, just to get my fix for gambling, I guess. And my assumption is that we're going to go under 100 by the end of the week. So I'm going to open a put debit spread, assuming that we're going to go below 100 if it's at a decent price. I'm sure that the premiums are pretty jacked up just because of the earnings report released today after hours. Implied volatility is going to be elevated, which does mean that you're going to be paying more than you otherwise would if implied volatility was low. But there might be a decent opportunity just because we're $3 away from it. So if we open that $100 put debit spread, it's about it's a better than 1-to-1 risk reward ratio now. So I was looking at it earlier and it was worse than 1-to-1 risk reward. But now it's actually improved. So let's see. For this trade, I'm willing to put up about $300 of risk, maybe $400 at best. So for me, I'll probably open 8 of these. Right now, Robinhood is quoting me for 45 each. We'll see if I can actually get filled for that price. Yeah, we got filled at 360 for 8 of them, so we actually got filled at the price that we wanted. I'll take that. So I just opened that Nike put debit spread, assuming that it's going to be below $100 by the end of this week, given that their earnings report is likely to come out bad, just like Lulu's earnings report did. I'll do a little bit more of an analysis here before I go in the next 15 minutes, just for the premium members so they know why I'm trading this. I always like to give a little bit more detail in my analysis. Let's see, though. All right, so open that put debit spread. So that is a new options alert. Premium 101 freemium. Just opened a new Nike put debit spread. Expires this week on the 23rd, if I remember right. 45 each. There we go. NKE earnings today after hours. Expecting similar to Lulu earnings. And Lulu fell, they gapped down really bad. Let's see. That day they dropped 8%. The day after their earnings. Given we have more volatility for the end of this week with GDP report Thursday, I think it could probably sell off a bit more. But if they have a good earnings, surprisingly, then I'll try to close out at a loss. So what I like to do ahead of an earnings report is I like to look at the past earnings releases. So what is their earnings over the last 2 years? So if we look at 1, 2, 3, 4, 5, 6, 7, 8 quarters, we had 78 cents earnings per share, 90-cent earnings per share, 93-cent earnings per share, 116-cent earnings per share, 83, 87, 90. I can't read that one. 93. And I guess this one we haven't got. 1, 2, 3, 4. 1, 2, 3, 4, 5, 6, 7, 8. Yes, that is 8. So 730 over 8, they came in at an average of 91 cent earnings per share. So I'm going to write a little comment here. Here we go. Average EPS was 91. And now I want to look at what Wall Street expects. So Wall Street, so I'll go to earningswhispers.com. earningswhispers.com. For NKE, are all the stock trading commercials on YouTube a scam? I mean, it's hard to say. You kind of have to vet the person and see, what kind of person they are. I would say that there are more scammy people than others, but it's kind of hard to discern who's a scam and who's not unless you do a little bit more research into that person. And even if you do research into that person, like we saw with SBF or Sam Bankman-Fried, we thought that he was this grand person, like this kind soul. It turns out that he was using other people's money to screw over investors, basically. But that Wall Street earnings per share is at 65 cent earnings per share, so they're likely to beat on this earnings per share. So I'll say likely beat. I do want to check to see if there's any seasonality to the earnings report. So what seasonality is each year around a certain quarter, the earnings per share might go up or down. So if we look at the previous quarters, it was 83 cents compared to 116 and 87. The one before that was 78 cents versus 95 and 90. So both of those years were significantly lower. The year before that was 52 cents versus 86 and 53. So there's a significant drop between Q3 and Q4, and I'm assuming that they're probably they're trying to offload their shelves by selling things at a discount. So let's see, 62 to 57. That's a 15-cent drop on 67. That's about 25%. This one was 86 to 52. That's about a 30% drop on 90. That's about a 30% drop. So 15, 30. This one was about 20 cents on 90. So about 20%, 15, 30, 20. And this one was another about 30% drop, 25%. So 15, 30, 25, 20, 15, 30, 25, 20, 90 over 4. So the average drop from Q3 to Q4 has been about 22.5%. So given that the last earnings per share was 93, we multiply that by 0.785. You would get about 73-cent earnings per share. So the likelihood of them beating on the earnings per share is pretty high. It's going to be a very marginal beat probably. But given that that's lower than it was last year, the year before that, not the year before that, but given that their earnings per share is steadily declining and we have these recession fears that are flooding into the market, I think that it's still going to get a decent sell-off. But I do want to look at some price levels. So this is the last part of my analysis, is setting up some price levels. Right now we're looking at the weekly chart. I generally like to look at the daily chart, and this is the first thing that stands out to me, is this gap that was created from 1110 to 1111, which was about, let's see, the low was actually 110.14, so that's a price level to look out for. The bottom of the gap, I guess, was 99.68. Since it's so close to the 100.14 level, not really significant. But the next level of significance would probably be this candle right here. So you would use the open and the close price of the candle. Excuse me, I'm sorry. 96.33. It closed at 99.49. You divide that by 2, and you get 97.91. $97.91. So that's probably worst case scenario, given that the expected range is above 96.9. It could sell off more than that. You know, the options market could always be wrong, and it could always make more move than what's expected, but we'll see. Last ER was positive, but Nike tanked 12% the next day. Let's see, their last earnings report. Well, it looks like their last earnings report, they tanked from 94 all the way down to 86. So there wasn't really any sort of, I guess there was a bit of a recovery that tried to happen when it opened at 83. It went all the way up to 86, but then it ended up coming back down to end the day at 82.30. It did end up recovering some of that in the next few trading days. So it did end up trying to fill the gap, and it did end up eventually filling the gap at some point. It still left a lot of gaps in the chart, but yeah, I think that it's going to come below the gap that it had created these 2 days, 11.10 and 11.11. Not really sure what sent it up that much. Might have just been the overall market being very positive those days. Let me see. Yeah, those 2 days for the regular for the rest of the market was very positive. So Nike just kind of went up in tandem with the rest of the market. What's my biggest indicator that a stock will shoot up or plummet? I usually trade around earnings reports, so kind of like you saw with this analysis. I'm assuming that their earnings per share is going to come in a little bit higher than what's expected. But if you look at the last 2 years of earnings, it's still down pretty significantly. Year over year, if it's at 73, that's a 10% drop on 83 cents. That's a 12% drop year over year. And then if we look at the past year, it was 78 cents. So even over the last 2 years, their earnings has declined by about 5 cents. Over 78, about 6%. So overall, earnings is declining for Nike, likely to continue that chain, I guess, going into the recession next year. So it's really based on like an overall kind of comprehensive analysis of looking at the price charts, like I just showed you, looking at what the fundamentals, so what their earnings per share has been over the last couple of years when, money was very easy to come by versus now, obviously, a lot harder to come by with higher interest rates. So overall, we should see a pretty decent decline in Nike. Obviously, I could be wrong, hence why I only risked about $300 per trade or per this trade. But if I'm right about the trade, then I make 100 minus 45, 55 times 8, I make 440. So I risked about $350 to make 440. So the potential reward is a lot greater than the potential loss. But yeah, looks like it's a 10:59, so I guess we're coming to a close here. Want to check SPY right quickly. Currently trading at 381.39, so we ended up pulling back from the 382 mark. So kind of glad that I got out of the Iron Butterfly when I did, but maybe should have held it for a little bit longer since we traded that around that 382 mark for a few more minutes. So that's the end of today's live stream, and I will catch y'all tomorrow, same time at 9:30 in the morning. All right. See everybody.